Hi guys, today we're going to look at Alphabet Inc., otherwise known as the parent company of Google, and the ticker symbol is GOOG. Using my 7 steps, let's just have a quick look at the stock price since the pandemic. You can see here it was around about $1,500 a share, dropped down to just over $1,000 a share at the bottom of the pandemic, and has rebounded very strongly, currently at its all-time high of $2,433 a share. If we go in a little bit more closely just over the last year, you can see it is trading above all of its major moving averages. We have a 50-day in blue, a 100-day in yellow, and a 200-day in red. So the 50-day is acting at support as a support level for quite a long time. If we go out, it hasn't broke below this since October. So since October, the 50-day has acted as support. So let's have a look at my 7 steps. First, is the PE ratio less than the market? Yes, it is. Google has a surprisingly low PE ratio of 32.43. Obviously, we do like it a little bit lower, but a tech company like this having a PE ratio at around 30 is not bad at all, as the tech sector is 40. So Google has got 2 passes right off the bat, not lower than the historical average of the S&P 500, but I wouldn't expect that for a tech company like Google. So is the revenue increasing? Yes, it is. It's gone from 110 billion to 196 billion. It's jumped up quite dramatically. 110 billion, 136, 161, 182, and then just shy of 200 billion. So revenue has increased massively over the last few years. Now we want to see, is the profit increasing? And the answer is yes, massively. 12 billion to 51 billion. So this profit has been increasing year over year once again. Now, are Google buying back their shares? Yes, they are. They've been consistently buying back their shares over the last 4 years, so that's good. They're rewarding shareholders for buying their stock. Just want to say thanks for watching. Please leave a like if you enjoyed the video, and give a thought on your comments on Google. Are you surprised by the low PE ratio, relatively low PE ratio of the stock? Now we look at the current assets, and these are normally great for tech companies. Are the current assets greater than the current liabilities? Yes, 170 billion to 56 billion. And with a bonus mark, the total liabilities of Google are only 97 billion. So they have 147 billion in total assets, and they've got 97 billion in total debt. So they could pay off everything they wanted to right now if they wanted. But they don't, but they certainly can. So I'm going to give them a bonus mark there. And finally, is the free cash flow increasing? Yes, it's gone from 23 billion to just over 50 billion, and this free cash flow has been increasing year over year, a bit more dramatically in the last 2 years, in 2020 and in the trailing 12 months, 42 billion and 50 billion respectively, but the free cash flow is increasing. So that gives 8 passes, 7 core passes, and an extra bonus mark here for the current assets being greater than total liabilities. So that is 8 passes, very surprising. Knew it was a hell of a stock, didn't realize it was this good fundamentally. And the free cash flow yield and ratio, very good considering that this stock is very high at the minute, 3% with a ratio of 30. You do want these lower, but if you bought this stock a few months ago, it would have been definitely in the range. So it is looking like a buy based on the fundamentals here. So now we go on to my calculations of Google. So I have calculated the future free cash flows here, created a terminal value of 2025, and then discounted that to a potential value of the future cash flows. You can see Google currently has a weighted average cost of capital of 7.35% with its market cap and shares outstanding. The calculated stock price is currently trading at a 2.5% discount. So the calculated stock price based on discounted free cash flow is 2,487. So this is a buy, not a massive buy by discounted free cash flow, but these tech companies do tend to be undervalued by discounted free cash flow. So if we look at the Buffett-Graham intrinsic value, now we have a fair price, which is the fair value of the stock based on the earnings per share. The growth rate, that's 21%, that's massive, and the AAA bond yield, the treasury bond of 4.4%, and then it has a Graham price, which would be the price that you would buy it and you'd hold it for many years to come. So let's see what they value it as. Wow, so you can see here the fair value of Google is around about $3,800 a share, which is meaning it's at a 55% discount, and then a Graham price of $2,800, so a 16% discount right now. So according to Graham price, the stock is massively undervalued, and it is definitely buy right now. I am surprised by how good Google is fundamentally. Now, I knew it was solid fundamentally, but I just didn't realize it had relatively low PE ratio compared to the tech sector, which was one of the things you would think in tech companies. that would kind of hold you back. It's lower than Microsoft. Microsoft has a 34 PE ratio. Certainly a lot lower than Amazon, which has a 62 PE ratio. So compared to a lot of the FANG stocks, so for example Netflix, once again, that has a PE ratio of 60. So compared to a lot of the other FANG stocks, Apple is a little bit lower, but Google seems very well priced and definitely underpriced according to both of these models. So these models do say it is a buy. Right guys, I just want to say thank you for watching. Please leave a like if you enjoyed the video. Give a comment on what stock you want me to do next. Are you surprised by Google's valuation? It looks like a buy to me. I'm kicking myself for not buying more earlier in the year, and I'm still kicking myself now because it looks like it's at a great price. So once again, thank you for watching. Please leave a like if you enjoyed it, and I'll catch you guys next time.